Well, good evening, everyone. Thanks for joining us tonight with our How to Trade Gold Trend Lines webinar. Before we get started, I wanted to ask Lee, if you don't mind me asking you a quick question. Did we have the privilege of meeting you when you were in New York? I apologize. We actually had to leave our booth a little bit early at the Traders Expo, and I just wanted to ask you if we had the privilege of meeting you up there, somebody from our team. Okay, well, Thomas is going to reach out to you. I really apologize about that. We unfortunately had a kind of a tight travel schedule, and we're trying to juggle that around and stay as long as we could. But very sorry about that. We're going to, Thomas will reach out to you and talk to you more about that. But again, I apologize for that. We sure would have enjoyed that opportunity, and hopefully we will have that opportunity here again. So we appreciate your participation on our webinars and in our live trading room, along with everyone else. But Lee, we apologize for missing you because we were looking forward to that. Okay, well, let's go ahead and get things started. If I start to sound funny, it's because I woke up at 1:30 this morning Central Time to catch my flight. So I start to get groggy a little bit. We have 2 kids, and so I'm starting to get on their school schedule. So I tend to go to bed earlier and wake up earlier, but not that early. But anyways, well, listen, I want to thank everyone for coming. Let's go ahead and kick things off here. I want to respect everyone's time. Let's talk about how to trade gold trend lines. Can everybody see the screen okay? Just to check there. Can everybody see my, okay, excellent. Everybody, it sounds like everybody can also hear me. Excellent. All right, just before we get started, with your permission, I want to go ahead and let's take a look at the markets, because there's some interesting things happening here in 2 markets in particular. One of them I believe I either made a video or blogged about today, but that's the soybeans market. So let's go ahead and look at soybeans here. A couple of days ago, for those of you who are on Signal Feed and in the live trading room, we broadcasted a red-tipped Doji here, buy signal, and the idea behind that is, I'm going to go ahead and enlarge my chart, my daily chart here. When you get these signals like this, these can really be good. Now, this signal kind of just really traded sideways a little bit. I know Thomas mentioned that the second day here, which was the 14th, that we had, you guys in the live trading room were looking to buy soybeans down here at moderately undervalued. And for those of you who held on, a beautiful trade there. You could be upwards of up as much as 70% on that trade. So nicely done if you've held on to that. But talking about this yellow tip Doji pattern just briefly here, I think that's a nice pattern right there. That and sometimes what we try to do is, obviously we're looking to place our stop below that pattern typically, or if there's another support level close by, we do that. We use that as our stop placement target. And then the idea behind this is to buy on the open of the falling bar. When you're dealing with daily bars, you have to give it a little bit more wiggle room. In this case, obviously, a lot more, maybe about 25 cents of risk there. But that so far has proved to be a really nice trade here, and I think there's more legs underneath this longer term. But we'll have to watch this market. At the very minimum, though, you should be able to lock in potential profits or put a break-even stop in now very safely. So the soybeans market did not head right up, but it didn't break the lows. So you're good on that trade. If you bought on the open the next bar, if you put your stop below the low of the red tip Doji, you're in great shape with that. So I think there's a good chance beans are heading higher to much higher over the next couple of weeks and months. The weekly bars look like they're just poised to go back up and test the 1,500 level here, the $15 a bushel level. And I think if we break that, we could see things really start to get exciting here over the spring. And there's an old adage in trading, I've never actually validated this, and I've heard said several different ways, and that is, if beans are higher in the spring than they were in January, then you're looking at the potential blowout moves in the summer. And I've also heard it, Andrew Cardwell, who's a very noteworthy technician, has said that he has heard, or he felt like if beans were higher in February than they were in March, or in January, excuse me, I believe I'm quoting him correctly here, then we should be looking at also the same thing. So some exciting potential moves. So that's kind of that the old adage in soybeans. Let's take a quick look at gold here. I actually published a buy signal earlier today. I went long myself when I got back from my trip about 12 a.m. Central. You can see where I bought here. And that's not, I wouldn't say that's super strategic here short term. I actually made the mistake of going to eat lunch before I put my trade on. I could have caught a really nice situation here where prices dipped down and moderately undervalued. I missed that, but I just went ahead and put 2 contracts on, and I'm holding on to that trade. I gave it a lot of wiggle room. So far it's up $760, so that's a good trade. And I'm holding that onto that longer term. I'll probably move my stop up to break even once the price is head a little bit higher, or at least maybe below this low right here of 1602.60. So that's still intact. The ultimate low, or the corrective low before that's below 1600, and then there's one as low as 1596 that would be very conservative. But going back to the weekly charts, we're right on the bottom of this flag pattern here. We've been tracking that for several weeks now, and I believe you might have talked about that, Thomas, last week in the live trading room. Prices came right down to that. Thomas and I were talking about that as a target, and it came right down and nailed that target. We're dead on there. Beautiful buying opportunity for those who are quick enough in the trigger. Anytime you see gold do that, get close to a target level like that, a beautiful trend line target level, and also get into significantly undervalued on the daily, that can be a very special opportunity. So you really want to watch that, and then the idea is to drill down when you see that happen to try to find a good strategic entry point. And really what you want to do here is you'll see the 120 minutes, they came up and traded moderately undervalued. If you bought here, you're in great shape, not risking hardly anything there. Prices went up, and you could have moved a break-even stop potentially there and not really hardly risked anything. You would have been stopped out, but there's really no loss there. You came back down here to correct again, and depending where you got in, if you got in significantly undervalued, you're in good shape there. So I think that gold has some upward potential here. This is a longer-term play for me. I think that ultimately I expect gold to go back up potentially again and retest and break the upper side of this flag pattern. So that's, and then the last trade I'm going to, this is just, yeah, frustrating, but I was up, you can see how early I was up in the morning. I think this trade is put on at, I guess last night before I went to bed, and then I put a break-even stop. It went my direction a little bit in the euro currency, and then this morning I was break-even stop, no problem. It was down at moderately undervalued on a 60-minute, so very happy to buy it there. And then I got on a plane and just had a stop in maybe 100. I was risking maybe 100 or 200 bucks in 2 contracts here. Literally frustrating here. I stopped out at 1331 or 133.31, and the low was 133.30. And I know we all hate to hear other traders complain about that, but that's my frustrating trade here, because now I would have been up 2,000 plus on that had that not happened. But my unfortunate situation was I was in the air when that happened. I didn't have an opportunity to buy right back, and I don't know that it would have, but I might have. So, all right, let's dive right into our presentation and talk about how to trade gold trend lines. So be watching the soybeans to the upside. I think they're definitely overbought now, so I wouldn't, I can't tell you what to do, but I would not buy at these levels. I would wait for maybe prices to correct shorter term, maybe 60, 120, 240 down to something more reasonable. They're very overvalued right now because we've had such a big surge. Gold, I think, looks good. Again, we buy undervalued, and you put yourself in pretty good shape there, potentially. So let's talk about the risk disclaimers here. We'd like to do that. Trading or investing carries a high level of risk, especially in futures. Understand the leverage and the risks associated with leverage. We are a company that believes we have a very special way to trade the markets. We think it's very effective, but there is a risk of loss regardless. There's no technique I've ever seen that can guarantee you to make money. So please understand, if you're trading the markets, you are putting your money at risk. If any of you want this, by the way, these disclaimers, we'd be more than happy to email these to you as well to let you take a closer look at those. The other one that we'd like to talk about, and we're not going to really talk about any hypothetical results, but hypothetical results are inherently flawed. There's a validity to them, but there's also a limitation to those. So if you ever see any company present hypotheticals, take it in stride, and a lot of times, depending on how they came up with them, they can be highly erroneous. They can be very, very inaccurate. So at best case, my experience with hypotheticals is we hope to achieve maybe 70% of what they tell us, assuming that we are not looking at a global maxima with our results. If that's the case, it's going to be a lot worse than that. But if you're using a genetic optimizer properly, and if you're optimizing properly, in my experience, then we expect, or we hope to at least make 70%. And there again, there's no guarantee of that, but understand that hypothetical results do have limitations as well. All right, we're talking about trend lines here, I've seen and read about traders who have different ways of creating trend lines, and each of us have our own way of doing it. I'm going to show you some ways today of doing it, but in a very basic sense, we're looking to connect at least 2 low bars or at least 2 high points, daily lows or daily highs, or bar lows or bar highs, depending on whether we're looking at intraday or end of day charts together to create that. And then if you get 3 or more lows or highs, that strengthens the signal, in my opinion. The idea in gold is that if you see a downside breakdown or breakout of a upward sloping trend line, then you should see momentum really spike and take off. It should just fall apart. The market should. It generally does that. However, sometimes the market can come back and retest that trend line, and then there are cases as well where it doesn't fall. It stalls out, and that's a huge warning sign if that happens. Prices could retest again a broken trend line. We'll see some examples of that. And then failed trend line break. That happened recently actually in gold. That we'll look at that example. That you watch out. If you see it break down and you see it pause and there's no momentum follow through, then you may want to buy. If it's a down breakdown. So be careful. But whenever you're dealing with a situation like that, you always want to use stop losses, and you still want to enter markets strategically. I'm going to go ahead and just display my questions here. Okay, James, you asked a quick question. Do you like to trade futures options off of something like a yellow tip doji and soybeans? Yeah, I think you could, certainly. I would keep an eye on volatility, but certainly if you had done that, that would have been beautiful, because you saw going just taking a snapshot again of our chart here of the soybeans market. You can see on a daily basis we had a huge upsurge here. So that would have turned out beautifully had you done that. But yeah, so certainly no problem with that. We do expect the markets to have a timely follow through. So if soybeans stalled out for another day or two and had that not really gone up there, I would have been concerned. But it really took a little bit of time. Sometimes it snaps right back. Sometimes you're wrong, it stops you right out. But when they do work out, we would typically like to see them go in the desired direction, within a couple of price bars. And I think even Thomas has a rule about that as well, and he can even chime in here at the end during our question and answer. So Thomas, just put a check mark in your brain. He's actually on the call as well. He just flew back from New York, and appreciate his efforts to be on this webinar as well. All right, but these are the trend line rules here. It's just very basic stuff. Just keep that in the back of your mind. Let's take a look at some examples. I went ahead and made some PowerPoint slides of a few trend line examples, and then I thought we'd pull up the charts and then draw some ourselves. Now, these are just from a daily chart. We know that gold spiked up close to $2,000 an ounce. I think it got up to the high 1900s, and then corrected here, and then basically we saw gold, chop up here, really can trade higher. We saw a losing momentum situation here, and this is what you want to watch out for. Okay, so at this point in time, we have a situation where we can connect not really this low, that doesn't really qualify, but certainly the lows in here. So we have several touches, and now you have a situation where you're seeing momentum really start to fall off there. So I'm going to go ahead and, I'm going to go ahead and, in fact, I'm going to go ahead and get my pen out here so I can draw on the screen, and I might even change my color to something that stands out. Okay, so right here, this situation, notice how the upward momentum right here with the indicator line and the signal line are higher, and then are much lower. The histogram's lower, and the indicator line's much lower. So this is fair value, and that's fine. That fair value can be a very good place to sell or buy, depending on what momentum's doing. So there's nothing wrong with that. But this is the type of thing you want to kind of look for with trend line breaks. So if we're playing this trend line right here, okay, got this trend line connecting a bunch of lows here, we're anticipating a breakdown, and then on a daily basis, okay, we're in fair value. I could pretty much say that you probably find a few moderately overvalued price points on the 60s, 120s, or 240s in this area, and that might be where you want to initiate a short. And those can be extremely low risk situations in anticipation of a potential breakdown here. Okay, so that's the goal. That's you see momentum dying out, you see the trend line forming here, and you're anticipating a potential break. And if you notice right here, if you measure this, this is literally a huge sell-off. So this is probably, I would say, close to maybe call it 1740 an ounce, all the way down to a low of below 1600. I mean, it's just it's a pretty massive sell-off there. So that's about maybe $150 an ounce, if I'm measuring that right, which is not bad. So, and on a trade like this, you can actually time it. There's ways to time this, so you're really not risking anything at all. If you don't sell right up here in the, drill down moderately overvalued intraday, then as soon as the breakdown happens right here, you could initiate a short right away. Okay. Let's see. I think I've got a question here. Let me see. It's Jim. You're asking a question. Let me see if I can pull up my tools here. Okay. I'll bring back my pointer. All right. How far apart should you use for a second point? Because your first example, and why put a trend line about a third of the way? Now, that's a really good question, okay? Because what you could have done here is you could have said, I'm going to use this point right here, okay? And I certainly probably would have done that in fairness. So let me go ahead and draw this here just to be completely accurate. This could have been a level right here that you've been watching, and if that happened, I don't know where that connects to, but that would have been a situation where the market sold off but stalled, wherever that connects, okay? So that's a failed trendline sell-off. And if you don't see the immediate pickup in momentum there, get out. So to answer your question, Jim, there's typically, I like to see, a number of bars, and it can really vary. And you're going to see in this example a few examples of typically between the first and then the second and third, there's going to be, at least in my experience, maybe 5 to 15 bars. And then between the second and the third, they really don't have to be a lot. So that in that case, but in fairness here, I think that would have been a failed attempt, but I don't think there would have been much money lost there. Okay, and then there again, you notice right here, this is a lower histogram situation, so that would correspond with this peak up here. So if you can drill down and find an overvalued situation, or even a candlestick pattern that almost looks like a doji there, that would have been potentially a great place to sell. But that wouldn't have qualified. That's a green doji, and I know Thomas doesn't really recommend trading those. But so that yeah, so in this case as well, we see a trend line right here, but you could have conceivably drawn another trend line, like this, okay? And that might have been a situation where you sold off and then you just didn't see a lot happening. And what's interesting there is this might have even been a consolidation, and if that happens, you're looking to get out. I mean, you want to see momentum spike fairly quickly. Okay, so if you sold this upper trend line and the market just kind of stalled out here, you're not really risking a lot there. You're not losing a lot. It's not reversing hard against you. Get out if it doesn't do something. And then it's interesting. I bet this is almost a perfect retest up here. Okay, that could have been a major sell signal, and then you could have used the new trend line kind of in anticipation that you might have tested that. Now, if you look down here, the momentum is not sharply lower here according to the histogram, and it looks a little bit lower in both cases. The indicator line, the histogram line are a little lower, so you could have anticipated this, sold this at moderately overvalued here. And keep in mind, this is a daily chart, okay? So you might have, once you got into moderately overvalued up here or fair value over here, then you drill down to your 120s or 240s even and try to find an attractive momentum picture, and also find a situation where you would have bought or sold it overvalued short term. That's what I try to do in anticipation. If you don't do that, there's nothing wrong with trading this breakout right here. So when it heads down towards your line, you're watching momentum at that point. Value is not part of the picture there, okay? Because it'll probably be, we're looking at a value migration short term. So even if you caught this right here and the market really started to fall off through this, chances are you're not risking a lot. You can put your stop above the trend line here, not very far above, but definitely you want to put a risk management stop in there, and you're drilling down to shorter terms. And what I would do is you can put a break, sell the breakout, sell the increase in momentum there as soon as it breaks the line, and then you really want to see prices fall off hard, okay, typically. Now, I'd say they fall off hard the majority of the time. If it's a valid signal and maybe 1/3 of the time they seem to come back and actually have a trend line correction. Okay, let's go to the next chart here. This is actually a trade that I made, one of my better trades in recent history. And what happened was there's a number of things happening here. We had the pennant pattern right here. So we've got this lower trend line right here. Prices are kind of consolidating this pennant pattern, and we have this initial breakout. I missed that. I wasn't even really, I was in development mode there. I wasn't even really trading much. And then we had a breakout of this longer term trend line. And this is really a reason why you want to look at longer terms, okay? You want to do that because that can be very, very relevant. Okay, you see the longer term trend line. If you were drilled in to where your price chart only included this right here, then you would not have known that this was a longer term trend line. That was really an important part of the puzzle, because this point right here where we have a correction that comes back to retest that trend line is exactly what I was watching, because I was aware of that trend line. So it pays to look back a couple of years, oftentimes to see what's happening with your weeklies or your monthly charts even, or at least, put a year or two of data on with your dailies to watch that, okay, because that was key support right there. You see the trend line break and then retest. Okay, now it's not uncommon when you see the break to the upside to see a retest. Okay, now if it would have broken down through there, I'm not risking a lot there. I put a trade on, I drilled down, it was actually moderately undervalued on a shorter term price chart when I bought that. And literally I had maybe $40 to $50 an ounce made in a week or so. So it worked out really well. That's another example of the upside. Okay. Now these are some trend line examples that I found that I didn't take advantage of. So these are just some that I was putting out there. Now notice right here, this isn't really touching there. So that might have even intersected, with these prices up in here. Okay. So that's a situation again where if that was your trend line, you're using this low right here, your trend line is going to be a little bit higher here. If you broke down, notice it stalls out a little bit on 60s. If you get that stalling action and it just even a momentum picture that's actually suggesting that things are strengthening, like right here, you'll notice, see this, it's hard to see this, but on a 60-minute chart, your histogram right there is strengthening, barely, okay? So strengthening right there, and that's right where you would have broken down out of that top trend line had you used this bottom right here. That's a huge red flag. You want to see it spike down. You want to see something like this, okay, when it sells off. You don't want to see a strengthening bullish divergence scenario. Then you want to run for the hills if that happens. Okay, so this trend line, we draw it the second place here, and then it comes back down very closely and touches it around here again. And then it finally breaks down, but it doesn't really do much. Okay, so it breaks down and it actually bounces back and consolidates. And then this is a situation where if I were selling that, I would get out. Okay, right here, I'd just say I'm out of here. But here's what you're watching for here. And then it comes back and has a retest right here. So you can sell that, and then if it starts to fall off again, put a break-even stop in, and then it comes right back up. You would have been stopped out. Now here's where it gets really good. It's really hard to see, and I apologize for that because we're using PowerPoint slides. The 60 minutes traded moderately overvalued here, and they went up and also retested the trend line. When you get a situation where you have a break, you have a retest that's moderately overvalued, that's a beautiful situation potentially, because you can put your stop right above the trend line, and then it could be conceivably a very, very low risk trade. Those are the ones I really like to watch for, and those can be really nice. And you can see what happened. Gold sold off by, it looks like around, let's see here, 10, 20, maybe $30 an ounce or so, it looks like, upwards to $25, $30 an ounce. So that's not a bad move on a 60-minute. Literally within 5 hours, you could have had $25 an ounce made on that trade. So that's a nice one. All right, now here again, now this is where it gets a little bit tricky, where again you have this higher trend line again. Okay, so if you use this initial point right here, and you're using this higher trend line, then you would have intersected somewhere up in here. Okay, now you're selling off, but look what's happening down with momentum. Your histogram right here is higher. Okay, if you have a breakdown, you stall out, even for 10, 15 minutes, it's just kind of sitting there, get out. That's not what you're looking for. You're looking for something like this. See that avalanche effect? And see how when that really starts to fall off, when you see a major down thrust, you're usually penetrating this lower 25 line in your MQ momentum. That's what you're looking for. Okay, so if you use that upper trend line, there's nothing wrong with that because you have 2 low points here, and if you use that, then that's a failure, and get out, run for the hills, wait. But that becomes your new low reference point. So this point number 2, I'll say this is 2. Point number 3 is what you want to look at. You X out number 2 because that's invalid. So you have point number 1 and point number 3 creating your trend line, and then up here you're watching, and you can see momentum starting to die off up here. Even though it's fair value, you see it start to die off both in your histogram and your indicator. And that's what if you want to anticipate the break, those are beautiful situations to get short, and in anticipation of a trend line test. Okay. If you don't want to do that, if you want to wait for the break, then as soon as you see the break, you want to start to see momentum really pick up the downside. And I don't know why gold does this more than most markets. It seems to do it, in my opinion, more than most markets. Is when you have the really nice downside breaks like this, you seem to have just things fall apart, and people are just running for the hills. And I love it because that creates a trading opportunity where you can make $20 or $30 an ounce in a few hours, which is beautiful. Okay, there again. Now these are some of the trades that I actually did take in some of these other ones. We were watching, we actually broadcasted some of these on the daily videos of the day and things like that. Notice what's happening here. This actually represents, in my opinion, 2 trading opportunities. Okay, this first one, you kind of get that situation. Again, look what's happening here. If you're anticipating it, which you should be, because this is just acting corrective, especially when it fails to really go very high here, look at your momentum. It's down considerably here. You're not only in the indicator line, but also the histogram. Look at your, migration index is down as well considerably, that high over here. And then you're also moderately overvalued in 60 minutes. I mean, there is absolutely extremely low risk there if you're trading in anticipation of that break. Okay, so that's just trading opportunity number 1 right here. This is really a great one, but you're anticipating a break. Let's say, for argument's sake, let's say that now you don't have really a trend line, I don't think, any valid trend line up in here. You were looking for wider swings when you form them. So, but even if you sold up here, in areas up here, those are great sell signals. So moderately overvalued there is still not bad. Moderately overvalued here, you still kind of spike off of that. You're not looking at a lot of risk there. You're probably looking at the market doing a lot of nothing, and hopefully you get out even almost break even or with a slight loss there. This is still a great place to sell, a great location to sell up there. But with respect to a trend line, in looking at an anticipation of a break, this is what you want to look at. That is the anticipation point. I put an A there, and then this is the break. So that is what you want to look at. And you're not looking at value here. It's undervalued. Okay, that's fine. And you want it to get a heck of a lot more undervalued because this is a value migration situation right here as soon as it breaks down. And this created an opportunity of maybe $10 an ounce or so. At the very minimum, I would say once you have a degree of separation of $10 an ounce, put a break-even stop in there. And if you would have done that, you would have been out break-even. That's nothing wrong with that, okay? But what happened here is you get the rare retest, and right there you have that number 2 retest. So this is the break, the B, and then you have the retest. In fact, I should just make this an R for retest. Okay, Ronald, you said, why not a trend line under the second circle? Are you talking about up in this area, Ronald? This higher area up here? Okay, see, in my mind, there's not. This is not this. I view this whole thing as kind of an upper cycle. Okay, so I see these as more of the grand cycles here, the larger scale cycles. I'm looking to make my trend lines off of these. So what I'm looking for here is I'm not really looking at trend lines up in this area because there's not really any linear connection of the lows. Okay, so that would have been ambitious there. Look for the more larger scale. It's not really macro, but larger scale cycles here. And you're not really even thinking trend line, okay, until you're at point A. That's when you're all of a sudden saying, okay, I've got a trend line here. Okay, so don't hunt for trend lines too much because that could be something. Let trend lines come to you. And notice that in a lot of these situations, you have a number of bars. You may be looking at 50 bars on the intraday and that sort of thing. Okay, Elizabeth, how do you determine how long you stay in a trade once it gets out? That's a very good question. What I would say is one thing you could do is once you see the break is drill down, maybe to like a 15-minute momentum. And if you're looking at a 15-minute cycle, or you can even look at 5 if you wanted to, but you could wait until you have the green uptick on your histogram here to get out. So you have the downward spike, things prices really start to sell off here. As soon as you get that first green histogram bar there, you can get out. Or, just watch, drill down to 5-minute charts, and as soon as you have a bullish divergence, then you want to get out. So just that, there's not really a perfect science there, but it's a give or take situation. Are you playing the $25, $30 an ounce sell-off? I got out of one trade, I'll show you here shortly, too early. I got out maybe after $12 of gain or $15 and ended up selling off like 35. So, but that's a good question. That's kind of a, I would challenge you to study those situations historically. I would look at maybe 5 to 15 minute, maybe even 30-minute as well, histogram bars for the MQ momentum. And see what that shows, see what kind of results you get with that as one idea. And the other thing I might suggest you look at is take a look at tick bars as well. Maybe 50 to 250, 500, and 1,000 tick bars. And we can actually pull that up here in a minute if everyone would like on TradeStation, because the tick bars can be very, very helpful in trading when volatility gets crazy like this. Okay, Jim, maybe use a trend line over the tops. Okay, let me see here. You're talking about as a potential exit. Yeah, Ali, you're right. Tick bars are really good for high momentum. I'll show you that in a minute. But you could use a trend line as you're talking about, Jim, maybe along here, maybe as an exit. That could be, that could be or earlier even. Yeah, I'm sorry, my screen. Yeah, nice. Yeah, very nice. That is actually one right there. It's not bad at all. So if you had this other one, I'm sorry my screen's so cluttered here, but that actually connects. Now, I'm not necessarily looking for those in a downtrend. I'm more looking for the prices once they get in that downtrending mode. I'm looking for the meltdowns, if you will, where gold just gets hammered once it breaks through. Okay. Yeah, earlier, Jim, thanks. Let's see here. Okay, another example here, and this is the one that I actually traded, and I was looking to. Okay. My screen's getting a little crazy here. Let me see if I can. Okay, it's flashing here. Okay, this is right here where we saw a bearish divergence. We see higher prices and we see a lower histogram reading. And Thomas trades with these all the time in the trade room. I like to look at those situations right here as an anticipation move. Now, I didn't sell it there. Okay, I was just busy doing something else, but I sold it right in here. I think I actually got in short. It was maybe around 1697. Because I was anticipating, I felt fairly confident that we were going to test that trend line. Okay, so I thought this was kind of all behavior that could have been, I was thinking actually, I think at one point in time we might find some support down here. But once I saw the trend line in play there, I thought there was a good chance that the traders would try to test that. And so I sold it up in here, and it started really picking up steam. It wasn't a great entry, really. I missed the perfect entry up here, which I'll call the anticipation move, the A. And so I sold it a little late there, but still momentum seemed to carry it down. I was in pretty good shape. And then once it broke, we can see that momentum just really got hammered here. The market got hammered. And I think I got out. I took my profits way too early. I think I took out like right around here, $15 an ounce or up in here somewhere. So I left a lot of money on the table, but it kind of stalled out here and then had a second leg down, which is somewhat unusual. It doesn't always do that. But that's where you kind of maybe want to look at the tick bars, especially when you're having this kind of volatility. Tick bars can be fairly helpful. All right, let's see here. I think this is actually, I was actually traveling with this, and I had this on and still kind of kicking myself. I was talking to another trader about this and talking about going short this situation. It might have been, yeah, it was. I was at, we were talking to Hubert Centers about that. He's a big gold fan, and I was actually short this, and then I had to get some stuff done during the day, and I actually ended up not taking it off because I couldn't really watch it, and sure enough, literally within 30 minutes or an hour of that, it just got hammered. So it ended up doing what we wanted. But this is another really nice example, and you can see that momentum again goes right down below that 25, and things happen fairly quickly, and that's what you want to have happen. So the anticipation was great, but I think that happened early in the morning. So that I think I was actually even short somewhere in here, and then you can see we barely poked up into moderately overvalued. To me, it's not painting a really strong anticipation picture, because the momentum you can see is not really dropping. It's more just flatlining. But so I don't know, but I was still short up in here because I saw this more as a just consolidation area, and I just felt like we were going to make a go of the trend line. It sure did. Went down and got hammered. All right, let's go to another example here. I think this is a situation where, okay, this is where I got off the plane coming back from my trip. And I was getting off the plane in Dallas. Like, I looked at my smartphone, my iPhone, looked at prices, and this is where some government official, I can't remember whether it was I think it might have been a congressman or something said something that the meltdown was, the fiscal cliff was unavoidable or something, and it's caused the markets to go haywire. But just to throw this out there, this is a situation where you want to really watch for, because that is a beautiful buying opportunity. Great bullish divergence. We don't even actually reach new lows there, but it consolidates there. But you can see how momentum really picks up and increases from this previous low. So even though you're a seller up here, you want to watch for this type of trade as well. And this is where a government official comes out, rattles the market, gets the market, and it makes it, really sell off. And then you see prices, momentum really start to slow down. And that was a beautiful opportunity to take advantage of maybe a counter trend trade where you could have made $10 to $20 an ounce on the upside. Okay, Center, you were asking, how often do you cover once the position goes your way and hits the $25 an ounce mark? Seems like a pretty good time to cover. I think that probably is a good idea. You can actually go back and study. I would say study the magnitude here of what the typical meltdown is. And you're probably going to find it does end up being probably around maybe $20 to $30. So if you hit $25, I'd say you should be pretty happy camper. And I would certainly be very happy. So I think that's a good observation there. All right, let's look at a few more examples here. We have, yet again, another nice, I'm sorry, I don't know, my screen's flashing here, but another nice trend line situation. So this is where you have 3 touches. You have your initial point, and then you have your first touch right here, and you have your second touch right here. So that's a nice situation. And then up here, let me move the question box. This is where this is a really nice situation here. In fact, if you can see, take a look at the migration index, which is it's really a great tool to get a pulse for the buying power and the selling power. So you get a pulse of the strength of supply and demand. And you'll notice that this is really fallen off right here on this area. And I would really challenge you to watch for this type of thing. I don't see this happen very often, and you'll notice that your momentum can't even get into positive territory here. Okay, now your fair value here, so this is not overvalued, but this is a situation where I would definitely challenge you to watch. And we've talked about in previous videos or webinars the idea of using what we call a kind of a system, a strategy-assisted technical approach where you could turn on a short strategy here, because the odds favor. You have momentum dropping off here with the indicator line, you have it dropping off here with the histogram, and then you have the migration index also agreeing with you, and then you've got a beautiful trend line down here as well. And so that, granted, there's a lot of dropping here, but sometimes these fair value areas right here where the market's so weak it can't even push very high, it flatlines like that, when it should, if it was strong, it'd be going way up like this and creating, a higher high. But it can't even do that. It can barely lift itself off the floor. These are the times where these represent some beautiful opportunities to short in this case. So watch for those. Those happen rarely. They can happen over time. The other comment I'd make is, notice over here I'm using a 32, 5, and 5 parameter set combination for my MQ momentum. If you use like a 50, 38, 10, for example, so it gives you a longer term perspective, you're going to see a very pronounced weakening of momentum here. And that would give you a strong clue that you want to be looking to play the short side in anticipation maybe of the trend line. So this almost is a totally separate trading opportunity up here. I don't even know if this is an anticipation trade, because this is a great potential shorting opportunity in its own right. But certainly you can see we get down here. Now, this is a little bit weird in terms of what happens here. So because you break the trend line and then you notice you consolidate here. Okay, so you can do one of two things here. You can say, okay, I'm out of this because I'm not falling off. I'm not getting that acceleration, even though you probably drop $6 or $7 an ounce away from this trend line. This is you're not getting that cliff-like effect with your momentum down here where it really drops down below 25. So this could be a trade where you get out, honestly. This is not quite the same, but it does end up going our direction. It does end up falling off. So there's really, study this. Go back and draw your own trend lines and study what you expect to have happen when that trend line breaks down. So in all honesty, that might have been one I would have even just gotten out of, because it didn't go at the rate of change that I would have wanted to see. Now there's let's see, I've got two slides that are fairly similar here. We talked about gold being in a pennant pattern here for a while on the 240s. Notice right here that we had the breakdown, and gold should have gotten hammered here. So gold should have been dropping like a rock here, and it didn't. And so when that happened and broke down, I was watching it very carefully. I bought it because I was thinking this thing is if it's not breaking down when it should, I actually bought it because I've got other reasons why I'm thinking longer term bullish here in the gold, but and so I took a couple dollars of the upside out with that. So that becomes the new reference point. Okay, so you've got your previous trend line. This is really a nice border here for the downside. So this first trend line is really nice. You have 4 touches here. So it's very well defined. But when you finally break, especially a 4-touch trend line like that, and you don't have a meltdown, then if you have a short position on, then be very, very careful. I would even suggest that you might even want to get out if you don't see that, after a few minutes, that acceleration to the downside. So be careful and always use stops. Okay, so now what happens is when you see a situation like that, you have to readjust your bottom trend line. So the next slide, readjust that. That becomes, this point right here becomes a new low. So now you have that as your reference point, and then all of a sudden we finally get what we're looking for. We get that sell-off, and it gets pretty close to down 25, but not quite. So, but I think we have maybe a $15 an ounce profit here. We also, let's see, I don't know if I've got let me go back to my trade station here. In fact, let me use my cursor. If you've been following the situation with the pennant pattern here, last week, I don't know if it was a blog or a video, but we talked about when gold was up here still, maybe around the 1625 area, we talked about how, maybe even higher than that, it might have been around 1635 or so. We felt pretty confident that I was going to break and test the 1628 low, and we talked about it even coming down here. So we anticipated that there was a good chance this could happen. I'm now thinking that this could be a potentially, again, I've been looking for a bottom here in gold. I've been wrong about a bottom, and we're looking for a longer term bottom, and that's going to happen. So you're gonna continue to try different things, but if I buy in the right side of value, I'm really not risking a lot, and I can even make money counter trend with that. So if I would have been looking to short more aggressively, and I have shorted quite a bit over the last couple of weeks and taken advantage of some of these trend line breaks, but I've been more bullish longer term just because our government's printing dollar like it's water. So I think at some point in time, gold's got to go up against the dollar in a massive way at some point. So that's the backdrop of what I'm using as my fundamental perspective. All right. So anyways, just to recap here, let's any questions at this point in time? In fact, we probably even now's the time where we might want to go into some Q&A a little bit. I'm actually long again gold, and I'm gonna if we can get gold to move up a little higher here, I'll probably put in a break-even stop. I like what I saw earlier on the 30 minutes. You can see how the momentum picture didn't even dip down on a negative. That's what we call momentum inflection point, and that was really my motivative factor for being optimistic with a long position. I think it looks pretty good, but I'm still going to watch it very carefully. I'm not going to risk a lot with this trade. So, but give it a little bit of wiggle room here. But I expect gold, if it's going to bottom here, then I expect it to start making some progress to the upside. All right, Lee, could you put down some tick bars? Excellent request. Yes, I can. Let's look at some examples of those. Hopefully TradeStation will generate those in a timely fashion. So format symbol. And for those of you not familiar with tick bars, there's different ways of aggregating data. Most people use a bar interval based on time, but you can also select a tick bar interval as well. And I like to look at, 250 is a good one, depending on how active a market is. But 250 to 500. And the idea here, let's see, in fact, I need to probably format this to take us back to at least maybe first part of, or maybe, yeah, I think October should be good. It may take a second to do this, but the tick bar, the idea is every time there's 250 ticks generated, that creates a bar. So instead of, for example, a 60-minute bar, you would require 60 minutes to pass before you started building another bar. The requirement here is for 250 ticks to go by before building a bar. Now, the advantage of having a tick bar, let me see how far back this takes me in terms of time. Okay, so it takes us back a little bit. Let's see if we can find a situation where in fact, let me go back to my presentation here. The recent breakdown here was, let's see, I don't even have the date showing. It's a 240-minute. Let me see if I can find that. So that would have been probably right around maybe the 15th. Earlier than that, just a second here. I'm going to try to find the breakdown date there. It looks like, okay, right here. So it might have been the 11th where we finally broke down. Okay, so let me go to the 11th here. That's the 8th. It's harder to find these points on a tick bar chart because it's pictured very differently. Okay, here we go. Okay, I think this is it. Now notice what's happening here with your tick bars. Now if you go back over here to the hourly chart, for example, and let me go back to the 11th, and notice how the risk is right here. If you have a momentum indicator, a lot can happen within an hour's time. Okay, and it's only going to build out one bar. If every bar is used to drive an indicator or drive a system, the weakness of time aggregation is that you have way too much movement here. I mean, if you have it in nature, and you could have a lot in the desired direction, your system or indicator even adapts or reacts to that. The benefit of the tick bar is it builds out every single time you have X number of ticks, in this case 250. Now, when I use a tick bar aggregation, I'm usually using inputs a little bit longer than the 32, 5, and 5. I might even use like maybe a 50, 25, and 8, and you can play around with that. Okay, now see what's happening here. This is a really nice situation. I'm going to go ahead and insert a strategy we call, in fact, you could even use a basic breakout strategy. I'll show you here how this might work. Okay, now notice how if you're bearish, okay, and let's say you're anticipating the break hasn't happened yet, but it's about to. You can pull up a tick bar, aggregation, maybe 250 or 500, and use a simple breakout, and see how nice this works. You're only looking to take the short side here. I'm ignoring the long signals because I want some sort of a rule-based approach to take advantage of a potential breakdown. And so if you did this with a very basic unoptimized breakout system, you're selling at 1674 on here at 1661. So not a bad deal. $13 an ounce made in a very, very short period of time. In fact, this takes place at call it 8 o'clock in the morning. They're about 8:17, and you're out by 8:53. So not even an hour. You're talking about, what is that, about 20, 30 minutes? Yeah, 30-something minutes. That's not a bad deal. It's not bad pay for 30 minutes time frame. So if you use a momentum-based approach, and then I like momentum as well with tick bars, I'm going to use a momentum strategy that comes with our large bundle called MQ Momentum Signals. Let's see if I can find that. Okay, see, this is the, let's see here. Okay, there's a specific one I'm actually looking for. This might be it right here. Okay, you know what, I'm looking at indicators. That's, forgive me, this is an indication of a lack of sleep here. You're saying, let me go to strategies, that might help. Okay, here we go, signals. Okay, so I'm looking at sell. Okay, so I'm going to use the same settings. I've got 50, 25, and 8. So I'm going to go ahead and turn the status off my breakout. I'm going to use 50, 25, and 8. The reason why I want to use longer settings is because tick bars can be very noisy. If you get a noisy period and you don't give them a little bit of wiggle room, then they can chop you up quite a bit. Now, notice in momentum, it works out really nicely. If you're right about the general tone of the market and you get that sell-off, this is beautiful. Turn it up, pull up a tick chart, apply a momentum strategy, lengthen, play around with some different settings, but I recommend higher settings like a 50-25-8 is a good one. And notice how we sell up here at 16.75, and look at our exit, 16.59. I mean, that's beautiful. $15 an ounce taken out. And then let's say you think there's more downside here. I mean, look at even the next two trades. This is not much of a loss here. So 16.61.70, you're out at 16.62.10. Okay, so you lost a fraction of a point there. Who cares about that? You actually make money in this next one. Okay. 16.61 selling and covering at 16.58, so a couple dollars an ounce. At this point in time, your move has happened, so you're not interested in trading all this. In fact, the danger and the limitations to tick charts is exactly what you see happening here. Okay, if you're not careful and your settings are too short term and you get into a really choppy area, it can really chop you up. So you want to use it, in anticipation of kind of that big down move. Let's see if we can find another example here. Yeah, and see right here, if you anticipate, this big down period, that's not even that big. See if I can find another example here. There we go. I think this is, I think this is a situation where we had that. Let's see here. Might have been that green period up here. Yeah, that's right. I think that's right around that period that I was pointing out where the market was in fair value. Now, one thing you could do is in that particular, if you're looking at an anticipation move, okay, one thing that you might want to do is you might want to say, okay, I'm going to start my move right here with a 50-25-8, okay, and let's say you start to get a degree of separation. The market actually goes your direction. You now have $10 an ounce in your pocket. One thing you could do if you want a longer term play, don't be afraid to extend this out. Now make it 100 and make this 50. Okay, and make this maybe 15 just to see what it looks like. Don't be afraid to do that. Let me see if properties are, make that 100 so it accommodates. Okay, so now look at what happened here. So you've extended that out. You're in the driver's seat, and you can put a break-even loss in at that point in time. Look at how effective this is. So if you do get that kind of drawn-out longer move, you have a number of very nice winning trades in a row using tick bars and momentum. Okay, so that works out really well. And you can still use time bars with momentum. I mean, look how many winning trades are on a row. These are all pretty nice trades. You got once on the top, 1, 2, 3. And these trades are taking out nice chunks. Like this one right here, you're selling at 16.80, and you're covering at 16.65, and that's $15 an ounce. This one right here, you're selling at 16.62, and you're covering at 16.51. So that's $11 an ounce. These are really nice trades, and look at how much risk you have there. I mean, it's hardly any. If it's wrong, I mean, if you're wrong about the direction, then you don't have a lot at risk here per se. The real risk with the tick strategy is if you get chopped up in a really sideways choppy period, you need to be very, very careful about that. So think about the idea of putting a tick momentum strategy on, and then if maybe a little more reactive, like the 50-25 setting. And then if you think there's a longer move there, if you think there's a more, potential there, then don't be afraid to lengthen that out. Just let it ride and just let it govern your trade and get you in and out several times if you think there's a really nice long potential move there. All right, Jim, what was the first strategy? That was a breakout, and that's a very simple strategy. If you guys are interested in that, shoot us an email, or if you want to shoot Thomas an email, and I will get you a copy of that. In fact, the code is very, very simple. We can even shoot you a copy of that and an ELD file. Very, very simple breakout. Buying the new highs, breaking out of new highs or lows. This is looking ahead with a 25-bar look back period there. So that's one. I think you might even have that standard in TradeStation. If you don't, we'd be more than happy to pass that along for that. And I think it's pretty easy to put into Ninja and multi-charts as well. Okay, where can I find the momentum strategy, Pat? That is part of our large bundle. So if you go to our website, let's see here. You're welcome, Jim. let's see, go to our website, www.valuecharts.com. And if you look at our different, I don't know, depending on what platform, let's say you're a Ninja Trader, the large bundle down here has the MQ strategies. Okay, so in fact, I'm not even sure if they've updated this to list them, but it does come with it. The MQ momentum buy strategy and the MQ momentum sell strategy. If you own the large bundle and you don't have those are a later addition, shoot us an email and we'll get those to you. But those are now included. The MQ momentum strategies are now included. Okay, yeah, Jim, if you don't have that, shoot us an email and we'll get you those. So that is now included, and if we add it later on, then you benefit. We'll get that to you for free. You bet. Okay, any more questions? The ideas we talked about today are fairly straightforward. Think anticipation. A lot of this is anticipating what could happen. And let the trends come to you. Let the trend lines come to you. Don't get overly zealous. Like, for example, let's go back to some time charts here. Don't get overly zealous with trying to find trend lines. Let them come to you. Let them really define themselves over a period of time. Those can often be the best ones. And the ones that typically have 3 or more touches ended up oftentimes being even more powerful ones, where you see a more pronounced breakdown when it eventually does sell off. All right, Thomas, any words of wisdom? Are you still on with us? Poor Thomas hasn't had much sleep, and he's been working. He worked the New York Traders Expo for most of the day today, or half the day at least, and then had to fly out back to Raleigh. So.
Hey, Mark, I'm here. No, I think you covered it pretty well.
Okay, well, let's see here. Let me just make a quick announcement with respect to, we've got some upcoming workshops. I just want to make everybody aware of these. We have one this is building and designing trading strategies. So if you're interested in learning how to use strategies, and you don't even have to leave them on all the time. If you're interested in learning how to use them when you want to turn them on or turn them off, or I'm going to share with you a lot of the lessons that I've learned over 20 years of developing strategies. I was one of the first TradeStation users back when TradeStation was called Omega Research, and their first platform was called System Writer Plus. This is in the late 80s, early 90s. Metastock had a very early platform out there as well, so that was among the very first users. It was really a lot of fun. I would literally be downloading data at night, and it would take me 30 minutes to download data for like 20 markets. It was just crazy. You'd use your dial-up modem, and if if a family member picked up the phone, it would destroy your whole download. So you'd have to start over. You'd have to go warn all your family members not to pick up the phone when it was dialing in for data. So those are the good old days. But I've learned a lot about system development since then, and we're going to go from soup to nuts. How do you develop systems? I'm going to give away several systems that are included with the course as well, that you guys can take with you. It's going to be a lot of fun. It's going to be over, looks like, I think 2 days, and then you should have a pretty good idea of how do you develop a system, what are parameters, what are variables, how do you test them. That's a big deal. I'm going to tell you what to watch out for, what to stay away from. We're going to look at brute force, genetic optimizations, and everything that's included in most platforms like Ninja Trader or TradeStation or Multicharts. So, I'd love to have you join me there if you have the inclination to learn about that. And Thomas is going to be teaching about divergence trading, and this has been a dynamite strategy he's been using in the live trading room for all of you who have been following Thomas there. So I would welcome you to also check that out as well. And then that's all we have for this video, or I'm sorry, this webinar. So, but yeah, so